I'm on the threshold of reaching the Roth IRA contribution limit. Should I fully fund my traditional 401k, then stack cash and make a Roth IRA contribution after the new year? Bonnie, thanks for your question, and congratulations to you for socking that kind of money away. The Roth IRA is a great place to put retirement savings because of the features of it. You put after-tax money into it, and on the back end, it grows tax-deferred and is withdrawn tax-free in retirement. And I think it's important to have as much tax-free retirement income as possible. If we could do it all tax-free, John, that'd be the best thing, but you don't want to leave money on the table from your employer.
No, you don't. You definitely don't want to do that, but we do love the Roth IRA. Just this past week, I was in Hot Springs for a Social Security workshop that we had over there with Joel and Lexi Newbern, our team over in Hot Springs, and we were talking about the Roth IRA and the benefits on Social Security taxation that the Roth IRA gives you because of how the government calculates your tax on Social Security. So Roth IRA is something that you definitely want to do. But in Bonnie's particular case, it just kind of strikes us that this is probably either someone who has a substantial amount of income or they're living on a tight budget or whatever the case may be. But I think that there's a real key to the sequence of contributions in this, Scott. And I think that the first thing that you want to do in that sequence is to max out the employer match, as you had alluded to. Maxing out the employer match means you don't leave any of their money on the table. You get as much of that as you possibly can. Once you have maxed out the corporate match, so let's say that your corporation that you work for matches 50 cents on the dollar up to 6% of your salary. So if you contribute 6%, you're going to get the maximum contribution because they're not going to match anything in that 1%. If you go to 7%, they're not going to match that 1%, but they will match 50 cents on the dollar up to the first 6. So what we would tell someone like Bonnie to do is be sure you're getting all of that corporate match first, and then contribute to the Roth IRA. Now, the Roth IRA, there are some limits to that and income limits to that as well.
Right. Yeah. So if you are a married filing, or if you're married and you file your tax return jointly, there is an income limit for you to be eligible to go into the front end of that Roth IRA, and it's in the $240,000, $230,000 income range.
Most Arkansans would be below that level.
Right. And you would still be able to participate in the Roth 401k if that's an option. And that's something that we probably should kind of walk through as well. We did this on a show or two ago. In fact, the difference between a Roth 401k and a regular Roth IRA. So if you break that down, you mentioned the contribution limits. In a 401k employer-sponsored plan, and this would include traditional 401k or a Roth 401k, it doesn't matter. The combined amount you can get in is $22,500 on an annual basis, unless you are 50 or older. And that's defined as if you turn 50 this year, then you are eligible for a contribution catch-up that will send you to $30,000 total that can go into a traditional 401k or a Roth 401k or both. But the combined total can't go over either $22,500 if you're under 50 or $30,000 if you're 50 or older. The Roth or traditional IRA is separate from that. It's outside that wrapper. It's not an employer-sponsored plan. You're doing this on your own, and that limit is $6,500 annually, or an additional $1,000 catch-up if you're 50 or older, which makes it $7,500, and that goes in any sequence as well. It's combined, right? It can all go in the traditional, it can all go in the Roth, or you can split it if you wanted to, but that's the combined contribution limit. So if you look at those totals, John, when you think about Bonnie really hammering her retirement savings, she's doing a great job if she has that kind of margin in her life, whether it's living on a tight budget or because she has higher income. But if you're under 50, you could get $29,000 in combined from those two instruments.
Right.
Or if you're 50 plus, $37,500. So there's a great opportunity there for you to run hard at retirement no matter what your age.
So let's be clear on the sequence. 401k matching contribution first. You want to do that. Then switch to the Roth. put as much money as you can in the Roth, be it $6,500, $7,500, depending on your age, and then go back to the 401k to finish out your maximization of the 401k plan. Scott, I think it's really important that anything beyond that, if you're fortunate enough to be able to save more than that $29,000 or $37,500, whatever the case may be, if you're able to do that, then you want to go into some after-tax investments to keep building up that after-tax money for retirement.
Yeah, you are very blessed if you can do that, because, we mentioned the $37,500 if you're 50 and older. That's per person, right? So if it's a married couple, you can get more than $70,000 a year just into those retirement accounts. And I do think it's worth pointing out before we leave this question too, the tax question. We talk about the tax features of a Roth IRA versus the traditional 401k, which is going to go in pre-tax and then be taxed at ordinary income tax rates on the retirement side. If Bonnie is a higher earner, it is worth considering taxes now versus taxes later, right? So this is why balancing. Obviously, you don't want to give up the employer match, but also having a balance, being able to save on taxes now versus later. Because let's say Bonnie's married and she has a husband and they make $200,000 annually right now. In that's not too incredibly unheard of, right? If you both make a six-figure job, your federal tax bracket's going to land you somewhere around 24%, right? Under current tax rates. But in retirement, typically people are going to live on less. Your Social Security benefits are going to be a component of that income, which is not fully taxed. Only up to 85% of the benefit is taxable. So if, let's say, they're going to live on $120,000 in retirement, you have a standard deduction of $27,700, and now you have an additional deduction if you're 65. So in retirement, you could easily stay in a 12% tax bracket. So I know that was a lot there, a lot of numbers thrown at you, but if you're going to pay taxes on your money, wouldn't it be better to pay it at 12% if you could? So I think a good balance of pre-tax contributions and after-tax contributions is a way to go.
I agree, Scott, and I think that there's also another point that comes up in Bonnie's question that I wanted to just kind of editorialize for just a moment. We have this, what is being called a retirement crisis in this country, and the answer that most politicians come up with is to try to come up with more avenues to save. You've got the 401k, you've got the Roth 401k, you've got the IRA, you've got the traditional and Roth IRA. You've got all these things, lots of places for people to put money. But what you find is that 49% of Americans are saving zero for retirement. That's a stunning number. What we have is not a crisis of the availability for places to save. What we have is an education crisis. Mm-hmm. What we have is the motivation that is driven by financial education that encourages and motivates people to save money. And I think that's why shows like this are important. Having a relationship with a financial advisor is important, because all of those things work together to boost your retirement savings. You could have 10,000 places to put your money. It does not matter if you're not motivated to do it. And you got to understand that motivation comes from better understanding about your finances. And that's why the process that we use here at GenWealth is so important, because it is education based.
Yeah, and you got to make a commitment to it too, right, John? I mean, you talked about earlier with the government shutdown, not making a short-term, or not making a decision based on the short term, but on the long term. You've got to be willing to let it go for the long term, because it could be very easy for someone to start this and see the market go down like it did last year in 2022 and go, oh, that didn't work out.
Yeah, and that's exactly what an uneducated rookie investor would do.
Yeah.
They are looking for that immediate gratification, but when you understand the dynamics of long-term investing, you understand that is key to your financial independence.